Hello, a very good morning to all. It's such a pleasure to be here back. It's almost been, I guess, 3 months since I last took a session, and after that I had a little break, and after that the pandemic started. So I've not been teaching for almost 3 months, and it just feels amazing to be back to you to teach. Before I say anything else, before I get onto the subject, before I say anything else, I just want to share this one thing with you. Guys, I wish all the students, everybody who's watching this, I pray really sincerely, and even the students who are not watching, let everybody in the world get a career where they feel this kind of happiness when they get back to a job. This is something else, guys. So whatever job you are in at, whatever career you are going to, find something, and I hope you get something where you have this kind of excitement. Every day you wake up in the morning and you have this kind of excitement sitting over here and doing your job, and this kind of meaning and this kind of sense of satisfaction doing whatever you're doing. All the very best, first of all. And having said that, I'd like to give a big shout out to my team at Swasthik Academy and our cameraman Goban over there. Thank you, man. So for making this possible. I'm a bit nervous, let me confess. I have finally broken the realms of this physical world and I'm coming to you virtually. So that's a big move, I guess. So I'm really happy about it. So before we get on to the class, before we get on to SFM, I'd like to establish some ground rules, some basic things that I'd like to share before we start on the subject. So the first thing I want to tell you is that this is a recorded online class. Okay. So the first session I think will be uploaded in YouTube also. So you might see me on YouTube, or you might subscribe at our channel and you might buy the classes. Either way, it's a recorded session. Now the record session has a lot of advantages. You are at your leisure, you are at your home, you are at your free time. You can see this in the morning, in the evening, whenever your energy level is high, you can see this in your free time. At your convenience, you can use this. That's a beautiful advantage. We are beyond the limitations of geography. You can see this anywhere you want. Having said that, recorded classes have a major disadvantage. As someone who has used recorded class himself, we have an issue over here. The issue is that recorded classes breed lethargy like nothing else, because right now over here you have another tab opened up of Facebook, your phone is live with some Instagram story, pling, you just got a message from WhatsApp, your bladders are leaking, you're feeling thirsty, this, that, you have a lot going on, and it's very difficult for you to sit over here like this, to sit over here and concentrate. And that's a byproduct of 21st century, that we don't have that concentration span where we can watch, let alone this face. Okay, so to watch a channel for such a long time, and right now your eyes just went down to that scroll tab where it says 2 hours 54 minutes left or whatever number, and when you see that, you are like, oh re baba, I have to sit here for so long. It is kind of demotivating. So first thing I want to establish, I cannot compete with Kenny Sebastian, who is on Netflix or Amazon Prime. Okay, so I think I'm a pretty good teacher. I can hold you guys. If I've held you guys for so long, I think I can hold you guys, but I cannot compete with Money Heist on Netflix or any other show or movie you have on Amazon Prime. So the first thing I want to establish is that for all intents and purposes, this right here is a physical class. Okay, for all intents and purposes, we are in a physical class. I can see you and you can see me. We are sitting together. Let us have that respect. So right now you might be in your bed, you might be in the leisure of your bed, lying down or doing whatever. If that is happening, pause the video right now, get your stuff together, have your notebook, your pen, your pencil, your scale, your eraser, your stationery, everything, a bottle of water, something, go to the bathroom, take a leak, make yourself fresh, wash your face, be fresh and sit here ready to study. Point number 1. Okay, so the next so many hours until I say bye bye, until that happens, we are in this together. Now I am not so cruel, I'm a bit cruel, but I will give you breaks. And only when that break happens, you are allowed to pause the video and go away. Let us have that firm commitment to this class. Otherwise what happens is that a session that should have been over in 3 hours might as well take 3 weeks. Okay, it happens, guys. I've also used it myself. I've also used record class myself. Every 10 minutes you are like, what is going on? Netflix, WhatsApp, what's going on? That can happen. Let us avoid that. Okay, so now don't slouch, sit upright, have the notebook ready, open the notebook, write your name, do all that drama, and you are ready. Ready? Ready? Paka? Great. All right. So with that, let us begin our classes. Okay. Again, before I get on to the subject, I'd like to introduce you a bit to what's going on. First of all, I think I haven't introduced myself. My name is Ramon Dharma Rajan. I'm a chartered accountant with 4 years experience. I've been teaching for over around 4.5 years now. I've taught at various centers in India, Trivandrum, Chennai, Coimbatore, Bangalore, and even Mumbai. So I'm quite experienced, and quite ironically, how much of experience I have, every time I start a session, there is a tinge of nervousness in me. Right now I'm a bit nervous. So let's see how this works out. Let's hope for the best. Okay. So I was trained by the great S.S. Rajagopalan sir from Chennai and Raman sir from Trivandrum. So those two are my gurus. That's it about me. Now about the session we are going to have. There are some things that I'd like to start out. I'll start out with a story. Okay. I'll ask a few questions, and based on those questions, I will give you a rough idea of what is going to happen in the rest of the class. Okay. So the rest of the topics, what is going to happen, how things are going to proceed, you will get an idea from the story. So question number 1. First question, it's a very juvenile question, it's a foundation level simple question, but it works for any level. Okay, so question number 1, simple question. What happens to the profit of a company when the sales increases? Okay, simple, the profit increases. When the sales increases, the profit increases mostly. Question number 2, what happens to the profit of a company when the cost increases? Simple, when the cost increases, the profit will decrease. Fine, well and good. Question number 3, alright, question number 3, think, what happens to the cost of a company when the sales increases? Okay, now I want you to take a moment. Okay, we are not watching a movie, so you can pause, think about it, think carefully, and then you can resume. What happens to the cost of a company when the sales increases? Now there are various possible answers. I think at the final level, majority of you would say when the sales increases, the cost also increases. But before we go on to the answer, let us analyze the question and let us analyze the methodology of answering this question. This very simple foundation level problem. Let us understand the methodology. There are 2 ways of thinking when such a problem comes to you. When such a problem comes to you, there are 2 ways of thinking. First, you could think, okay, what is the formula? Sales minus cost equals profit. You could think of that formula. Or if you have a commerce background, 11th, 12th commerce background, then immediately you will draw ledger account and you will say, okay, by sales to cost and balance profit. And that formula, if you think in terms of that formula, you will analyze, see, sales minus cost is profit. So if sales increases, your profit will increase, but how will that affect the cost? That is what you are thinking. If you are thinking of a ledger, again that's your thought process. Your sales has gone up, which means your profit will go up. How will that affect the cost? That is method number 1. Now method number 2. Method number 2, when such a question comes to you, you could just close your eyes and for a moment virtually you can go into some supermarket or some restaurant or any place of your choice. Just walk into a supermarket and you see at the cash counter that more sales is happening, more products are being sold. Where did the products come? If more products have to be sold, more products have to be purchased. So then you will realize that the formula might not explain things, but when you go to the supermarket, when you physically put yourself, when you virtually put yourself over there, you will realize that if the sales has to increase, the cost also has to increase. Sure? Pakka? Not necessary. You could do this other thing. What happens? You are increasing your selling price. You are selling a product. Okay, let this be your product. You are selling this product. You are not selling more number of units. You are simply increasing the selling price. So when you increase the selling price, what happens? Sales will go up. Will that affect the cost? No, same pen. Okay, so that will not affect the cost. Increase in sales will not affect the cost. So I have given you two answers. Answer 1, increase in sales will affect your cost, will increase your cost. Answer 2, if you assume that selling price has been increased, increase in sales will not affect your cost. Option number 3, even without increasing my selling price, my sales is going up, but it is not affecting my cost. How is that possible? Think of a coaching center, or think of this video, think of this lecture video. Okay, I am not increasing the selling price, but simply by selling more number of videos. Or think of this coaching center where I am taking the class. If more number of students come to my class, my revenue goes up, but that is not affecting the cost. Same faculty remuneration, same air conditioner, same rent, everything remains the same. The cost remains the same. So now I have given you 3 answers, and it's a very juvenile story. Why I have explained this story to you is first to help you understand how to think. There are 2 ways of thinking, okay, and this rule applies at the inter level, at the final level, for SFM, very importantly for costing, for FR, tax, for everything. 2 ways of thinking. First is how the machine thinks. Okay, so you have a formula, sales minus cost is equal to profit, or you have a ledger and you just substitute figures into that formula and the formula will give you an answer. That is how this laptop over here will do the thinking. That is how a machine will do the thinking. You are a human being. You are a very creative, intelligent and imaginative human being. You are not going to do this formula. You are going to visualize what is going to happen. So for every scenario that we come across, for every question that we come across, you are going to think, okay, this is your money that's being invested. Your hard-earned money is being invested. You are the client, you are the investor, you are the banker, and you are the one doing the investment, you are the one getting the returns. It is your money. Think of it that way, and then you will get clarity. Because as the process starts, as we start, I will discuss a lot of formulas. The formulas are there only to support you and to help you and maybe make things a little easier and faster. They are not the final answer. For every scenario, for every question you face, you have to go to the supermarket like we just did now, or go to the restaurant, or think of increasing. And when that happens, you will think of different possibilities and different assumptions, and that is the right way of learning. That is the right way of learning, and that brings me to point number 2. You are here to learn. You are here to learn. The student sitting at the other side of the screen might be at different levels. You may have exam in a few weeks time, you may have exam in a few months time, you may have exam in a few years time. So you are all at different levels. I cannot change my teaching pattern according to that, so I have a uniform pattern. But the thing I want to convey is, all of you sitting over there must sit with a mentality to learn, absorb. Okay, this is not a ordeal. This is not a chore that you have to finish very quickly. This is not, you're not doing the dishes where you wipe out everything. Okay, ho gaya kaam. That is not how it is. You are learning, you are thinking, you are absorbing. So always when you are sitting over there, have that spirit of learning, have that spirit of thinking, which means your eyes once again flitted down to the crossbar, 2 hours 45 minutes left. Don't think of that. Don't think of that. Be in the moment right now and think. And every time I say something, you might find, okay, I know this. Fast forward. You might find, wait, he's got a point. How will the cost increase? Pause and think and learn and ask doubts. Okay, so at this point I think, or at the end of the video, you will have my phone number and my mail ID scrolling down below. So you can always contact me for doubts. Have those doubts. Share those doubts with your friends. You can share it with me. You can think, have different assumptions. In this course also, every question I'll try to give you alternate answers. Okay, I'll try to give you alternate answers. But otherwise, even beyond the textbook, even beyond my session, you may have some alternate answers. That is the learning method. That is the learning method. When that happens, you will make mistakes. In this question of increasing the cost or decreasing the cost, you might make a mistake. Have the guts to make those mistakes. Have the guts to make those mistakes, because only when you make mistakes, you will learn. So make plenty of mistakes. Some people have a lot of pride about their notebook. My notebook is pristine, not a single black mark should be there. After the course is over, I'll wind up the notebook and put it in a museum. I'll preserve it for the next 500 years. Don't have that kind of attitude. Your notebook should be like a battleground with lots of scars and creases and crosses, and it should be ripped apart with mistakes, because every time you make a mistake, you're going to learn something, and only like that will you learn something, guys. Understand? I'm here to guide you. The learning happens with you. The learning happens with you. So make a lot of mistakes. When a question like this comes of a much greater level or of a much simpler level, what happens to the cost when the sales increases? Pause, think of the various possibilities. Make mistakes, correct your mistake, and grow. I say we have 3 objectives. This session has 3 objectives. Objective number 3 is that you clear the exam. Objective number 2 is that you learn and grow. You learn, you understand the concept, and you grow as a smarter person and hopefully as a better person. You grow. That is what a teacher is supposed to do. That is what I hope to do. Point number 2, you grow. And point number 1 is that you enjoy the journey. Okay, because I think even if you get an all India rank or whatever happens, if you have not enjoyed the ride, if you have not enjoyed the way, if you have not enjoyed the process, then it's all futile. Yeah, then there is no use. Okay, so as a faculty and as a student, enjoy this process. I don't know, I think we have 5 or 10 minutes into the video. If you enjoyed it so far, and guys, I promise that you will enjoy this. Okay, I promise that SFM that you have signed up for is a beautiful subject. It is a wonderful subject, and you will have a lot of fun enjoying it. You will have a lot of fun learning it. It's a very enjoyable subject. Okay, so that is what is going to happen in this class. So on that note, let us begin strategic financial management. So first of all, let us quickly go through the topics, the syllabus that you have to cover. This will be the coverage that you have right over here, including the number of problems and what all topics will be covered: portfolio management, equity valuation, bond valuation, capital budgeting, mergers and acquisitions, derivatives, international finance, and mutual fund. In simpler terms, for CA Final new syllabus students, there is almost 90% coverage. Okay, there is almost an exhaustive coverage for the CA Final new syllabus students. The only topics that will not be discussed over here is one, international capital budgeting, but mind you, we are also discussing capital budgeting. We are discussing capital budgeting and we are discussing forex, which is international finance. So I am taking the liberty to kind of cut out international capital budgeting. That is one topic. And corporate valuation will again be covered in various topics such as mergers and acquisitions and equity valuation. We will cover corporate valuation. Okay, so that international capital budgeting is the only small area that we will be left out. For old syllabus students of CA Final, capital budgeting is being discussed, and mind you, this is important for new syllabus also. I just come to that. Okay, old syllabus students, capital budgeting and leasing are 2 major, very important scoring areas, but I am not discussing that in this lecture sessions. Okay, those 2 areas will not be discussed. Every other and a couple of smaller areas like financial service in India and money market are also, and dividend decisions. Dividend decisions, however, is covered in portfolio management and equity valuation. I will cover all the concepts of dividend decisions. Okay, although we are not doing problems separately, we will cover all the concepts. So this capital budgeting, we will discuss the concept, but the number of problems, we are just doing 4 problems. So it's a small, very limited coverage. Leasing will not be touched in this class. Okay, mind you. And some students of CMA Final, for CMA Final, guys, understand, again, like CA Final old syllabus students, you will miss out on capital budgeting extensively and leasing. Leasing will not be touched, and capital budgeting will be a limited coverage. Okay, that is one thing. And second thing, CMA Final students, we are also covering equity valuation, bond valuation, and also mergers and acquisitions. Now this area comes in another subject for you called business valuation. Okay, performance evaluation and business management, this area comes to you. Okay, so that is the coverage of our syllabus. The core areas, be it for CA Final old, new, or CMA Final, the core areas are portfolio management, equity valuation, derivatives, and international finance. these 4 chapters are where the real hit lies, and we are going to hit it very hard, so hard that when you come to the example, the kind of confidence you are brimming with, I promise you, will be of a different level. It will be like Thor landing at Wakanda. Bring me Thanos. That is the kind of confidence that you will have after this session for these 4 core chapters. Mergers and acquisitions is a big area, but we will discuss the concepts. Problems, your responsibility to do more number. The practice manual has around 60 problems. Okay, so as a percentage, the number of problems we are doing is quite small. We are doing every type of problem, but the number of problems is smaller, so it's your responsibility during self-study to do more problems. Refer CA Final, old syllabus, practice manual is a very good material to do more problems. Okay, so that is about the syllabus. Okay, so on that note, let us get to the topic strategic financial management. I am super excited, man. You have no idea. I'm super excited. Okay, students, if you are taking notes, open your notebook and go to the last page of your notebook. Okay, so we have a little system to maintain things methodologically. So what we do is we maintain something called the formula page. Okay, so if you want, you can open a different notebook, or simpler, not so much strain, go to the last page of your notebook, and in the last few pages we will write all the formula, theory, concepts, everything will come in the last. Speaking of theory, there are a few theory chapters. I will discuss about that in due course. Okay, I will mention that in due course. Now, our priority will be problem area. Okay. Now, go to the last page, that will be a formula page. All the formula, concepts, theory, logic, explanation, everything will come in the last few pages. 20 to 30 pages will be devoted to formulas and concepts. The point is, day before exam, quickly when you want to do revision, you don't have to scramble through, where is the notebook, where is Harman? You don't have to scramble for the formula. Just take out the last 20 to 30 pages, will have all the formulas that you need. Day before exam, day of exam, I won't recommend you revise. Okay, please don't revise day of exam. Day before exam, quickly 30 pages you can browse through, all the formulas are clear. That's the idea. Okay, and even while you are solving the problems, you have to check out some problem. What is the formula for covariance or correlation? Some formula you want to check out, you can easily cross reference in the last page of your notebook. Okay, so maintain that in a very disciplined manner. The last page of your notebook will be your formula page. Okay, so let us begin strategic financial management. Let us first understand what is it that we are learning in this subject. What are we learning in strategic financial management? I want to talk of 2 people who we are discussing about. First is the retail investor, you and I basically, and the second major area is called treasury. Very important area practically. First retail, let's talk about you and me. Qualified, you have qualified, we have qualified, I have already qualified. You get a job. How much do you want? Salary, starting salary, package. Let's take a figure, 1 lakh. Okay, this is your starting salary, take home. 1 lakh rupees you have starting salary, take home. Now out of that 1 lakh, say you have expenses coming to 40,000. So you are saving 60,000 rupees. You are saving 60,000 rupees. What do you do with this money? 60,000 every month is coming to your bank account as savings. What do you do with that money? What do you do with that surplus money? Okay, now don't start imagining, okay, 60,000 per month. So for 12 months, if I multiply, I'll get 7,20,000. Similarly, if I multiply for 10 years, I have 72 lakh. That doesn't work quite that way because of time value of money. I'm sorry, because of time value of money. Okay, you want to buy something, you want to buy a BMW car for 72 lakh. You cannot do it in 10 years. You cannot do it in 10 years because by the time you accumulate that 72 lakhs, the cost of BMW has gone up. It might go up to 7.2 crores. Therefore, it is very important that this money that you are saving should not lie ideally in your bank account. First of all, these are very trying times. So, if you have an earnings, please make sure you donate a part of it to the CM Relief Fund or a PM Cares Fund or whatever, or make some other charitable contribution of your own. Have a heart, guys, have a heart. And something that's left that you save for a rainy day, you have to invest. Where do you invest? First salary, your parents will inevitably tell you, beta, go start an FD, go open an FD. First thing, put that money in FD. Second, after you qualify, the people who are going to visit you, your relatives might not call you, your friends might not call you, your friends will definitely call you, friends are awesome. But the person who is going to come to your house and congratulate you is a banker. This banker fellow will come to your house, ask you about your salary and all those details and offer you a very interesting scheme, a very interesting mutual fund proposal. Okay, possibly he will coax you into it, he will pull you into it, you will make an investment in mutual fund. The banker will make sure that you make an investment in mutual fund. What else? Okay, traditional middle class family means again there will be investment in gold. Not a good investment, I don't like it personally, but even I have invested in gold. You go a little longer, then they might ask you to invest in land. Very good investment. Okay, so I have people who have a plot of land in every district of the state. Okay, so how do you make this decision? Okay, so that is the question that we are going to address. How are you going to make this decision? Where will you invest? Do you go for FD or do you go for land? How much in FD, how much in land? Or if you are more adventurous, you have other avenues. Your parents might not allow you, your parents might not encourage you to do this, but you have equity, debentures and all those options. Where will you make the investment? To understand that, we have to consider three factors. Any investment you make, you have to consider three factors. Factor number one is the return that particular investment is going to give you. What is the percentage of return this particular investment is going to give you? Second is the risk that you have to undertake to get this return. How much risk should you suffer to get that return? And third, point number 3, mentioned or not, it is price. So it's basically a derivative of return and risk. Price depends on return and risk. Okay, so these are the three factors that you have to consider when you are deciding to make an investment. Now forget your individual small 60,000 rupees salary, forget that. Think of a bank. Think of State Bank of India. State Bank of India has thousands of branches across the country, each accepting crores of rupees as deposits. And mind you, when State Bank of India accepts 1000 rupees as deposit, it will lend only 700 rupees. Balance 300 is with itself. Why? You have 4%. The rate has come down, I think it's 3.5% now due to COVID, due to increasing liquidity measures. RBI has reduced it to 3.5% as CRR, 20.5% as SLR. These rates keep changing. Balance around 6% will be held by the bank for a rainy day. Suddenly if Ambani ji comes and asks, sir, please give me money, you have to give a loan, so you will have some reserves of 6%. So this 300 rupees or 30% is kept by the bank as cash. Okay, not as physical cash. Now what do you do with this 300 rupees? That is the question. What do you do with this 300 rupees? Again, it has to be invested. Where would you invest it? How do you invest it? Now for SLR, 20.5% SLR, there are some rules. You have to invest only in government bonds. CRR, you have to invest only in cash or as balance with Reserve Bank. The 6% is your money. 6% is your money. What do you do with this money? And what you do with that 6% will be very crucial to your overall profitability. This 6%, you can analyze the balance sheets and the P&Ls of different banks, SBI, HDFC, SBI being the behemoth figure, the biggest bank. The figures are very clear over there. Then many years, what happens to this 6%? What happens to the increase in non-interest income? That is very determinant for the overall profit. And especially in this scenario, especially in the 2020, where the government and the Reserve Bank of India have taken so much measures to increase the liquidity for the bank, yet the lending has come down. In this scenario, how you deploy this additional fund is very crucial, and that is decided by a department called treasury. Not just for banks, consider big MNCs like Apple or Google. Now these are companies who have huge cash reserves, uninvested cash reserves lying in various currencies, and what they do with that cash reserves is very crucial to the overall profitability of the company. So all of these big MNCs, international banks, they all have a separate office called the treasury departments that decides how this free cash must be deployed most profitably. Again, keeping three things in mind. First, the return. Second, the risk. And third is the price. So you don't want to invest on a very expensive property. Keep in mind these three reasons. Keeping in mind these three reasons, you have to decide where do you invest your surplus funds, right? That is what we are going to discuss in the entire syllabus. Okay, we are going to discuss three factors. They are: one, return. This is the third time I am saying it, guys, so please don't get bored. Stay awake. Chap chap, wake up. I know you are sleeping. Second is risk, and third is price. These are the three factors we are going to discuss in every chapter. In the first chapter, portfolio management, we will discuss at length return and risk. These two concepts will be dealt with at length in the first chapter, portfolio management. In the second chapter, equity valuation, bond valuation, we are going to discuss about price. Going forward, in derivatives, we are going to discuss about risk and about a certain product called derivative instruments and the price of those instruments. In international finance, we are again going to discuss return, risk and price of a particular class of asset called as currency. So in the entire syllabus, we are just going to discuss these three fundamental principles. Guys, mind you, these fundamental principles are very important for the treasury operations of every company, and mind you, as a chartered accountant, it is very important that you are well aware of what is going on in the treasury operations. If you are going to audit, then it's very much possible that you would be auditing as a concurrent auditor or as a statutory auditor the treasury office of a bank. Or if you are going to an MNC, again as a part of the overall finance, you will have to audit the treasury operations. If you are into finance, then treasury is going to occupy a major part of your mind. How do you manage treasury? Okay, if you are into tax also, anyway, guys, understand, as a chartered accountant, whatever field you go into, audit, finance or tax, finance is going to be a part of it. If you are in finance, it's fully finance. If you are in tax or if you are into audit, finance is going to be a part of it, and a very integral part of finance is the treasury operations. In SFM, we are going to understand basically treasury operations. Even if you go and after you qualify, there is a course conducted by ICA called Treasury and Forex and Treasury Management. In concurrent audit, a significant part is devoted to audit of treasury operations. So these are very fundamental things for a chartered accountant. We are not going fully into treasury. Treasury is a vast area with a lot to learn. If you are interested, I'd recommend Rahul Magan to learn treasury at length. That guy does some explosive stuff on YouTube. Check out Rahul Magan. He does some explosive stuff on derivatives and the treasury market. We are discussing what is required for chartered accountants, the very fundamental principles: return, risk and price. So shall we begin? Let us start our discussion with return. Okay, so now you have your formula page ready. Write on the first subheading return. If you have been writing lecture notes, well and good for you. Now from here, notes formally start. Write the first subheading return. Return can be understood in three ways. Return can be understood in three ways. There are three aspects to return. First is actual return, what you have actually earned. Second is expected return, what you expect from an investment. I made an investment, what I expect from it next year. And third, the king of this chapter is the required. Very important concept. What is required? You have made an investment. How much should you demand from that investment? That is your required return. Okay. So let us start with the first formula, actual return. The first formula, actual return. Guys, now I am going to give you formulas, but please understand, in this class not a single formula will be by hearted. Everything will be understood very logically and very conceptually. Shall we begin? Imagine you have a plot of land that you purchased on 30th September 2019 for rupees 90 lakhs. You purchased for rupees 90 lakhs. On 31/3/2020, this land has a value of rupees 98 lakhs. During this period, you use that plot of land, you gave it out on rent, and you earned a rental income. You earned a rental income of rupees 1 lakh. Question: in this scenario, what is your return on investment? Okay, understand? You have made an investment of 90 lakh. You have made an investment of 90 lakh. After 6 months, on 31st March, its value has become 98 lakh. The investment has increased, appreciated, and become 98 lakh. And you also earned a rental income of 1 lakh during that period. Tell me, what is your return? Okay, the return in this case, the return is 1 lakh you have earned rent, that is the return, plus the value of your investment has gone up by 8 lakh. 98 minus 90, the value of your investment has gone up by 8 lakh. That 8 lakh is also part of your return. Okay. Now, if you think from an accounts perspective, this doesn't make sense, because in accountancy you have a concept called realization principle, which says you are allowed to account an income only when you realize it. Guys, that does not apply in finance, that does not apply in management. An increase in value of your investment is a return for you. You are not going to pass an entry for it. That is not being accounted, you are not going to pass an entry for it, but that is a return. So, your return over here is equal to 9 lakh. Okay, you have invested 90 lakh and you have earned a return of 9 lakh. Now, understand, in actual return, you have to take care of two rules. You have to take care of two rules in actual return. Rule number 1. Now, I just said you earned a return of 9 lakh. You earned a return of 9 lakh. Does that tell you anything about the quality of your investment? Your friend made an investment and he is saying, hey, I earned super investment, macha, I earned 9 lakh rupees. How did he earn this 9 lakh? Maybe he invested 1 lakh and earned 9 lakh. That is a beautiful investment, amazing investment. Maybe he invested 10 crore and then earned 9 lakh. In that case, it's a pathetic investment. So, now if you want the word return to tell you something about the investment, rule number 1, your actual return has to be a percentage. Your actual return has to be a percentage, which means 9 lakh by itself does not make much sense. You have to give it as a percentage of your initial investment. 9 lakh by 90 lakh, you get 10%. 9 lakh by 90 lakh, you get 10%. Now, that tells you something about the quality of the investment. Okay, this investment gave me a 10% return. Had I invested 1 crore, I would have got 10 lakhs. Had I invested 100 crore, I would have got 10 crore. Something of that sort. Okay, that will help you make and take decisions. Rule number 1. Now, rule number 2. Rule number 2. First, I said your return, whenever you mention return, whenever you say return, whenever you compute return, it has to be a percentage of your initial investment. Rule number 1. Rule number 2. Your return must always be annualized. You earned a return of 10%. When did you earn this return? 1 month, 2 months, 1 year, 10 years? When do you earn this? Okay, so in this case, you have earned 10% in 6 months. Now, that is difficult to explain. So, we are always going to make it in a uniform way. You are going to annualize it. 10% for 6 months. So, for 12 months, you get 10 into 12 by 6, that is 20% return. You are going to get 20% return, and that is your return. That is your return. Okay. So, what is return? The dividend you have earned. Now, for a plot of land, it could be rent. For a debenture, it could be interest. For an equity share, it will be the dividend you have earned plus the capital gain, the increase in price. Two rules: it has to be a percentage and it has to be annualized. So, on that backdrop you can say the first formula, return equals actual return R is equal to D1, the dividend you earned after the investment. You invested today, next year what is the dividend you are going to get? Okay, D1 means the dividend earned after the investment is made, plus capital gain. How do you get that? Price at the end of the year minus current market price plus P1 minus P0. D1 plus P1 minus P0 is your actual return. Now, two rules. One, it has to be a percentage divided by P0. Rule number 1. Rule number 2, guys, I am not going to put into 100, okay? Into 100 is there. When I do 9 lakh by 90 lakh, you get 0.1, which is nothing but 10%. This into 100 step, I will not write anywhere. Your CA final students, I am not going to explain this, spoon feed this to you one by one, okay? Into 100, I will write nowhere, but it is there, okay? So, whenever you do the computation, that into 100 is there. I am not going to say it out loud. It is there, it is implied. 0.1 is 10% and you are only going to express that at 10%. Please don't write 0.1, it is horrible. Please don't do that, okay? Okay, it is always 10%. D1 plus P1 minus P0 by P0, annualize it into 12 by M. Okay, for 6 months you have 10%, meaning for 12 months you have 20%. This is the formula for return. Now, mind you, some blue chip companies, some large companies, say Reliance, Tata, all these big shots, what they do two things. One, they make sure that dividend is paid out every year. Point number 1. Point number 2, they make sure that whatever dividend is being paid, there is a growth in that dividend. Okay, so every year the return that you get will grow by 2%. That return, that growth is also a part of your return plus G. What is the rate of growth? Every year your dividend is going to grow by 2%, means that 2% is also part of your return. Now, plus G, how is this mathematically explained? Why is this growth being added? We will discuss in the next chapter. In equity valuation, we will discuss how this plus G came over here, mathematical derivation, full thing I will give you in the next chapter. Okay, so formula number 1, R is equal to D1 plus P1 minus P0 by P0 into 12 by M plus G. First formula, actual return. Now, second formula is expected return. I will write EXP, I do not care. You are advised to write expected return. Now, let us deviate from investments. Virat Kohli was playing a series against Australia. First match, wonderful performance, he scored 101. Second match, just fell short, 98. Third match, 102. Fourth match, 99. Fifth match, what do you expect Virat Kohli to score? He might go out for luck, that's a different thing. Okay, actual is different. But based on these 4 matches that you have seen that Virat Kohli is in amazing form against Australia. The pitches are very favorable to him. He is doing very well against fast bowlers, all those things, you know. Based on these conditions, how much do you expect him to score in the next match? Okay, your normal expectancy would be around, you would expect him to naturally score a century. Given the nick he is in the past 4 matches, you naturally expect him to score a century. Now, let us come to our topic. Imagine a banker comes to you and gives you an investment proposal. Sir, beautiful investment, sir, investment in so and so project, amazing investment. Sir, look at their past 4 years performance. Year 1, they got 10% return. Year 2, they got 15% return. Year 3, 20%. And year 4, 25%. Just look at it, sir. Just look at it. Look at the growth they have. 10, 15, 20, 25. Sir, tell me, sir, what do you think? See, 10, 15, 20, 25. How much will they get in the next year? Come on, guys. How much will they get in the next year? How much? 30? This is what bankers generally do to you. They try to pull you in. Sir, 10, 15, 20, 25, 30. It is not 30. Understand, business has a cycle. In year 1, you got 10%. Means, and in year 4 you got 25%. which means a prudent investor, a prudent intelligent investor must think for the next year. What is the expectation? You cannot expect 30. Based on the past experience, you can say next year it could either be 10% or it could be 25%. A prudent investor will expect the average of the past 4 years. Okay, 10, 15, 20, 25. What is the average? I think you add up the total 10 plus 15, 25, 45, 70. 70 divided by 4, I think that is 35, I think that is 17.5%. A prudent investor will expect 17.5%. Expected return is nothing but the mean or the average of all possible returns. What is the average of all possible returns? And generally the possible returns are given by the past performance. Generally they are expected by the past performance. If it's a new company, if it's a brand new company, now when Swasthik Academy started for the first time, we had to do a survey to find out how many students would get, what is the possible return that we are going to get. We will do a survey and do some projections, all possible projections. If it's an existing company, you can just look at the past data. That's not negative by the way, I'm just putting hyphen, okay, they are arrow marks. The average of all possible returns, that is your expected return. Expected return, it's an average, it is symbolized by X bar. It is symbolized by X bar. X bar is nothing but average. How do you take the average? How do you take the average over here? Take the total. Total of X. Summation of X. The symbol intelligent folks might know, call it sigma. I call it summation because sigma there is something else. Okay. And then students start getting confused between that sigma and this sigma. So this symbol is always summation for me. Summation of the individual returns. X is the individual return. This is your X. This you will recall is same as your R. X is also R. X and R are the same thing. Instead of X, you can also use the symbol R. Okay. Summation of the individual returns divided by the number of returns. Simple average. Okay. Now, alternately, what could happen is see 10, 15, 20, 25. The banker might now argue. The banker might now argue, no, sir, you cannot take simple average. See, the company is growing. So, definitely there is a greater possibility that he will get 25% than 10%. There is a greater possibility because 25 is more recent. Okay, so this company has been growing. 25 is more recent. I agree. There is a slight possibility that the company will fall back to 10%. There is a slight possibility. But that is like the more possible return is 25%. In that case, you can take the weighted average. How do you take the weighted average? You allot probabilities. For 10% there is a 0.1 probability. For 15% there is a 0.2 probability. For 20% there is a 0.3 probability. And for 25% there is a 0.4 probability. Accordingly, how do you take weighted average? Guys, now this mathematics I am not going to dive deeper because in CA, Inter and various other places you have discussed what is weighted average. Okay, so I am jumping at it. How do you take weighted average? 10% is a 0.1 probability. So 10 into 0.1 is 1. 15 into 0.2, I think that's 3. 20 into 0.3 is 6 and 25 into 0.4 is 10. The total is 16, 19 and 20%. This is weighted average. Okay. So, expected return X bar can be simple average, the simple average, summation of the individual return divided by the number of items, or it could also be the weighted average, summation of, what do you take? Summation, the total, this 20 is the total of X into P, summation of X into P. This is your expected return. Now, what is expected return? Expected return is the average of all possible returns. What average? It could be the simple average or it could be the weighted average. Simple average, total divided by n, weighted average, individual item into probability, take the summation of X into P. Now, we are done with actual return and expected return. Before we go into required return, there is a long journey to be had. Let us move into risk. Let us move into risk. Very interesting area. Let us move into risk. Okay. After this, I'll give you a small break. Okay, just listen to me, pay attention. After this, I'll give you a small break. We can just stretch our arms and legs and we'll take a small break. So what is a risk? Now, if you have learnt IT or inter EIS, you would recall that risk is any possibility for loss. Any possibility for loss is risk. Now, in finance, risk has a slightly different meaning. Risk has a slightly different meaning. Any deviation. Any deviation is a risk. Any deviation from your expectation is a risk. You are expecting 10, you get 15 or you get 5. Any deviation from the average is a risk for you, because you know that whatever goes up must come down. Whatever goes up must come down. So you are expecting 10, 1 year you got 15 means next year you will go back to 5. Okay, so any deviation from the average is a risk. Let us take a small example. An investment proposal. I am giving you an investment proposal. You are analyzing the past 2 years data. You found out that the returns are 5% and 15%. Okay, past 2 years you have analyzed that the return is 5% and 15%. What is the expected return? Average 5 plus 15 by 2, 20 by 2, x bar. I am not going to write this down in detail. X bar is 10%. Your average is 10%. That is your expectation for the third year. Okay, first year 5, second year 15, third year you are expecting 10%. Now you are giving this investment proposal to your client. Now the client is asking you, okay Pava, seems like a good proposal, 10%. But before I invest, you have to give me guarantee. You have to promise me that I will get 10%. Can you promise him that you will get 10%? Pakka sure. No confusion. Then later you should not change. Okay, give it in writing 10%. Can you give it in writing? No, not possible to give it in writing, because based on the past experience, first year you have 5, second year 15, you are expecting, you are only expecting 10%. You are only expecting it to be 10%. Okay. Okay, so you cannot promise me. No sir, I cannot promise you. I am expecting, I am hoping it will be 10%. There could be some issue. Okay, fine, you cannot promise it. Chalo, chhod do. Tell me, how much should I expect risk? What is a risk? That you can say based on the past data. Look at this. You are expecting 10%. Okay, but in the past 2 years, did you get 10%? No. In the first year, you got 5%. Which in the first year, it was 5% less than the expectation. Correct. In the second year, you got 15%. You got 5% more than the expectation. So based on the past 2 years, can you not say that you are expecting a return of 10% and this return may go up or come down by 5%. There is a risk of 5%. There is a risk of 5% based on this data. Okay. Now I explain this concept in class, and several students, what they do, 5 minus 10 minus 5, very good. 15 minus 10 plus 5, very good. Average of minus 5 and plus 5, 5 minus 5 is 0. Sir, risk is 0 sir. No risk sir, super investment. That is a problem. Okay. Because you and I, as I have said earlier, we are machines, less human and more machines. Whatever formula is there, directly we just spit it out. Okay, so you have to be, so whoever came up with the standard deviation was a little creative. What he did was, okay, fine, now this negative over here might cause some trouble. So let us do something. Let us take the square. Let us take the square. So minus 5 squared, 25%, plus 5 squared, 25%. Average of 25 and 25, very good, it's 25%. Now here you have squared it, here take the square root of 25, coming back to 5%. So same 5%, you have got the same 5%, you have avoided this negative by taking a square, and this 5% is your risk. It is also called the standard deviation. This is also called the standard deviation. What is the risk? How much your expectation will deviate. You are expecting 10%. How much will it deviate? Okay, you have made investment. Reliance, Tata, somewhere you invested. You are expecting, your client has told you, your banker has told you, sir, you can expect 20%, sir, 20%. How much do you think? Will you get 20% for sure? Not sure. It might go up, it might come down. How much will it deviate? It will deviate by 5%. Now guys, please understand, I am giving you a very crude example. Here to remove the negative we have squared it. Actually there is a long story regarding the continuity curve and all these things. There is a long story over there. So I am not going into this because we are not discussing statistics, we are discussing the application of this statistical method. Okay, so why we are squaring it, don't go too deep, this is a very crude example, just leave it over there. Okay, so to remove the negative we are taking it square, minus 5 square 25, 5 square 25, average of 25 and 25 is 25, square root is 5%, and this is your standard deviation. Standard deviation, a risk can be expressed by standard deviation. Symbol is sigma. Standard deviation symbol is sigma. Formula, what did we do? First, x minus x bar. X minus x bar. We took out the deviation. X minus x bar. We got minus 5 and plus 5. Okay. Now we found out here there is a slight risk that students might end up saying this is 0. So what we do to avoid that risk? We took square of the deviation. Then what we do? Take the average of the squares. How we take the average? Summation and divide by n. You got the average is 25, and in the end, to top it all off, you find the square root. Okay. So standard deviation equals square root of summation of x minus x bar the whole square divided by n. When we learn it inside out. First x minus x bar, then square, then take the average, and then in the end put a square root. Okay. Now on this note, let me tell you one more thing. When we are discussing standard deviation, here look at this step, summation and divide by n. We have taken a simple average. We can also take a weighted average. In this example, if probability was given, there is a 0.4 and a 0.6. Suppose probability was given 0.4 and 0.6. Instead of divide by n, we will have to go for into p. Look at this, guys. Over here we did a into p. Over here we did a into p. Similarly, over here also there can be an into p. So you can also say the formula is alternately square root of summation of x minus x bar the whole squared into p. Okay. So the simple average, this weighted average, whenever in the question probability is given, we will take the weighted average. Got it? Now guys, understand we are just discussing the formula over here. When we do the problem, you will get proper clarity. I am just giving you an overview. Okay. So in your formula page, just write this down. Write this down very quickly. I am only giving you an overview of what is happening. When we do the problems, we will get proper clarity. Okay. So what have we discussed so far? We have discussed actual return. What is actual return? Actual return R equals, we discussed about that land property D1 plus P1 minus P0 by P0 into 12 by M plus G. Actual return. We discussed expected return. X bar is nothing but simple average, summation of the individual returns divided by number of items, or it could also be weighted average, summation of x into p. And now we just discussed risk, which is symbolized by standard deviation, square root of summation of x minus x bar the whole squared divided by n. Now I am not going to repeat this over and over again, guys. I am not going to repeat this over and over again. Wherever an into n is there, wherever simple average is there, it is also possible to use the weighted average into p. Okay, like this. Now again, this repeat itself in covariance in all these terms. I am not going to repeat it. Wherever there is a divide by n, there is also an into p. So now we are done with a risk. One more point to mention. One more point. Instead of risk, instead of standard deviation, risk can also be expressed using risk may be standard deviation, or it could be variance. This could either be standard deviation or variance. Variance is nothing but square of standard deviation. Variance is nothing but square of standard deviation. Variance also at a later stage we will discuss at length. Okay. So, I think that is almost an hour of lecture. Okay. So, now you can take a slight break, just stretch out, relax, drink some water, okay, and come back and we will go on with the chapter. Okay. Alright, see you guys back, ready? Okay. So, now we have just established, we have covered actual return and we have covered experiment, and now we have also covered risk. Okay. So, any deviation from the expectation is your risk. Risk can be given by standard deviation, we just discussed the formula, and variance. I will do an extensive example that will give you some more clarity in a few minutes. Now, the minute you say risk, the next question that should come to you is, how do I get rid of this risk? Okay, I made an investment, how do I get rid of this risk, or how do I reduce the risk? Now, universally, not just for investment, for any topic you do, for anything you do, there is one common universal strategy that has been adopted to reduce the risk, and that is formally known as diversification. Now, this can be seen in so many examples around us. So many of the students watching this video would have registered for CA, CMA and CS. Okay, give the foundation exam for all three, whichever you get. So, in case you don't clear one exam, you have other two exams as backup. Okay, you look at earlier, now there is a NEET program, but earlier MBBS students in my batch, I know students have written 36 entrance exams. Okay, engineering students even now they write BITS Pilani, IIT, IIM, All India, NIT, all these entrance, they give up half a dozen entrance exam, hoping if they don't get IIT, they still have NIT. If they don't have NIT, they at least have the state government college, and if even that falls short, BITS and all those other universities. Okay, so they diversify their risk. Some go to the other extent of engineering and medicine, and even CA entrance in between that. Okay, so that is a common strategy for diversification. In so many families, parents have two children, because if one is going to get spoiled, at least I have backup, the other one is there for me. So, that is diversification that happens in investment also. Warren Buffett has said, don't put all your eggs in one basket. Okay. So, instead of putting all your money in one avenue of investment, you diversify, you invest in more than one stocks. Okay. Instead of putting all your money in Reliance or all your money in Tata Motors, split it, half Reliance, half Tata Motors. That is what we are going to discuss next. Now, when we diversify, there are a few statistical terms that we have to understand. First is called covariance. Covariance is a relationship between two items. Okay, covariance is a relationship between two items. It is symbolized by covariance AB. Covariance between A and B. Okay, mind you, covariance of A does not exist. You cannot have covariance of one item. It's a relationship between two items. You cannot say covariance of ABC, threesome is not possible. A relationship between two items, only that is covariance. Okay, so covariance of AB is a certain relationship between A and B. What is the relationship? You will understand shortly. Okay, so covariance AB, the formula covariance AB, please note down, covariance AB is equal to summation of x minus x bar into y minus y bar, the whole divided by n. Okay, summation of x minus x bar into y minus y bar, the whole divided by n. I have mentioned earlier, wherever there is a divided by n, you can also do n into p. Okay, divided by n, simple average, into p, weighted average. Okay, let us look at an example. Now consider two stocks, A and B. Two investment opportunities, two shares where you are going to invest, A and B. Their returns, A has given a return of 5%, 10% and 15%. Possible returns are 5, 10 and 15. B has possible returns of 18, 12 and 6. and now the probability of return is for A and B. 0.2 that they get 5 and 18 respectively, 0.5 that they get 10 and 12 respectively, and 0.3 that they get 15 and 6 respectively. What is the standard deviation of A, standard deviation of B, and covariance AB? Okay, shall we discuss? So, for that I am going to use the most powerful tool known to mankind, which is Excel. It is a beautiful tool. Okay. So, articleship training, first thing that you do is change the font to Trebuchet. So, this is the question, two scenarios, two stocks A and B, 5, 10 and 15, 18, 12 and 6, probability of 0.2, 0.5 and 0.3, what is the standard deviation and the covariance? Let us check that out. Okay. So, you have probability of 0.2, 0.5 and 0.3. A has possible returns of 5, 10 and 15. Okay, I think the font size should be a tad bigger. Let us take that. I think that is better. And B has possible returns of 18, 12 and 6. Okay. So, first let us compute the returns. Now, A, I am going to call him X and B will be called Y. Okay. So, first is X into P, X into P. So, 5 into 0.2 you get 1, 10 into 0.5 you get 5, 15 into 0.3 you get 4.5, total is 10.5, that is the expected return of stock A. You guys understand, stock A has 3 possible returns, 5, 10 and 15, with the respective probabilities being 0.2, 0.5 and 0.3. So, with this data you can say the expected return is 10.5. Presentation I will tell you shortly. Next is Y into P, expected return of Y, 18 into 0.2, I think that is 3.6, 6 and 1.8, you get the total of 11.4. The expected return of A is 10.5 and the expected return of B is 11.4 percentage. This entire thing is in percentages. Okay. Next, let us move on to the standard deviation. Okay. So, first now I have some limitation in doing X bar. So, instead of X bar I am using a capital X. Okay. You guys please use X bar, I am using a capital X instead of X bar. Okay. First is X minus X bar. I am now going to take the standard deviation. Okay. I will do it in a separate table. Okay. X minus X bar. What is X? The individual return of A. This, guys, this is X. This is not X. This is not X. This is a very common mistake. Many people take 1 minus 10.5, 5 minus 10.5, 4 minus 10.5. That is wrong. Please don't do that. This is your X. 5, 10 and 15 minus X bar is this 10.5 over here. Okay. You have taken the weighted average. So, X minus X bar you get 5 minus 10.5, you get minus 5.5, 10 minus 10.5 is minus 0.5 and 15 minus 10.5 is 4.5, X minus X bar. Next thing is X minus X bar squared. X minus X bar squared. Okay, X minus X bar squared, that is 30.25, 0.25, 20.25, and lastly you have X minus X bar squared into P, 30.25 into probability 0.2, 6.05, 0.125 and 20.25. Okay. So, how do we take out the standard deviation? First, guys, your possible returns are 5, 10 and 15 and your average is 10.5. Now, from this average, you are deviating by minus 5.5, minus 0.5 and 4.5. Remove the negatives, you are taking the square. Minus 5.5 squared is 30.25, minus 0.5 squared is 0.25, 4.5 squared is 20.25. If probability was not given in the question, you would have simply taken a simple average. Okay, just take the total and divide by 3, but probability is given, so you have to take the weighted average. How do you take the weighted average? 30.25 into 0.2 is 6.05, 0.25 into 0.5 is 0.125, 20.25 into 0.3 is 6.075. Take the total and divide by, no, don't divide. Okay guys, understand, you have taken weighted average and you have multiplied with probability. Once you multiply with probability, you don't have to divide by 3. A very common mistake from beginners. Okay, they take the total and then again divide by 3, not required. Okay, once you have multiplied, look at the formula that we have seen over here, square root of x minus x bar the whole squared into p. Either it's divided by n or it is into p. Don't do both, don't mix both. Got it? Okay. Finally, take the square root. %3.5 is the standard deviation of A. Now let's look at B. Same process. Okay, y minus y bar squared minus y bar squared into p. Okay. Y minus y bar squared take the total of y minus y bar the whole squared into p. Yes, understand the formula once again. What we do, x minus x bar squared, average, and then eventually square root. Okay, now we have taken the average, I have multiplied with probability and taken the average over here, multiplied with probability and taken the average over here, taken the total, and finally is equal to 4.2 is the standard deviation of B. Step 1, take out the deviation, x minus x bar or y minus y bar. Step 2, square. Step 3, multiply with probability and take the average, which is the sum. Okay, 17.64. Square root is the standard deviation. Got it? 3.5 and 4.2%. Now finally covariance. Okay, x minus x bar, y minus y bar, x minus x bar, you know it's over here, y minus y bar also you know it's over here. Okay, let's take the total 1.5 and multiply the totals wrong. Multiply the totals wrong. This is wrong. Understand the formula for covariance. Understand the formula for covariance. Covariance equals summation of x minus x bar into y minus y bar. It is not summation of x minus x bar into summation of y minus y bar. It is summation of, there is an outside bracket also over here for that purpose, summation of x minus x bar into y minus y bar. So please don't multiply 1.5, don't multiply 1.5 with 1.8. These totals, don't even take them, don't even take the totals, multiply them individually. 5.5 into 6.6, minus 5.5 into 6.6 is minus 36.3, minus 0.5 into minus 0.6 is minus 0.3, 4.5 into minus 5.4 is 24.3. Summation of x minus x bar into y minus y bar divided by n if it was simple average, but in this question you have probability. In this question you have probability, so you have to take the weighted average into probability is over here into 0.2. Okay, 0.3 into 0.5, take the sum, minus 14.7 percentage, that is your covariance. X minus x bar, y minus y bar, multiply them, x minus x bar into y minus y bar, then take the weighted average. How do you take the weighted average? Multiply with the probability and then summation. That is your covariance. No square, no square root, nothing of the sort. Okay, and don't divide by n. Why have we not divided by n? Because it is weighted average. Got it? That is covariance. Now in this case we have a covariance of minus 14.7. What does that indicate? What does that mean? Okay, A and B, understand? A and B have a negative covariance of 14.7. What does that mean? A and B has a negative covariance of 14.7. A negative covariance of 14.7 doesn't mean much on its own. Covariance by itself, when I say covariance is minus 14.7, that by itself does not have much meaning. The purpose of covariance, AB, is to serve as a working note for correlation AB. R stands for correlation. Understand? Covariance by itself does not have any meaning. When you say this 14.7 or 14.2 or whatever, it does not have any meaning. The purpose of covariance is to serve as a working note for correlation. Now what is correlation? Beautiful. Correlation is a wonderful thing. Come on guys, this is exciting. Correlation AB, the correlation between A and B is basically a number between minus 1 to plus 1. When I say correlation between A and B, it can be a number between minus 1 and plus 1. Okay. What does a correlation of minus 1 means? Correlation of minus 1 means that A and B have a completely opposite relationship, which means, let us look at A and B. When the return of A goes up by 10%, the return of B will go down by 10% by the same proportion. That is what a correlation of minus 1 means. Correlation of minus 1 means perfectly negative. When one stock increases by 10%, the other will fall down by 10%. Imagine two CA coaching centers in your hometown. Okay, if one coaching center has increased its profitability, how does it increase? The other coaching center is declining. Okay, so when one institute declines, the other one goes up. That is an example of a perfectly negative correlation. Plus 1 is a perfectly positive correlation, which means if A goes up by 10%, B will also go up by 10%. Same. For example, think of Swasthik Academy, the foundation and the inter batches. If the number of students in foundation goes up by 10%, correspondingly the number of students in inter will also go up by 10%. If the number of inter students goes up by 10 students, correspondingly the number of final students will also go up by 10%. Now that is an example of a perfect correlation. Plus 1. Plus 1 is also called perfectly correlated. So they need not mention correlation is plus 1, they could use the word perfectly correlated. Perfectly correlated means R equals plus 1. If R is 0.5 plus 0.5, it means they are positively correlated, but the correlation is only halfway. When A goes up by 10%, B will only go up by 5%. Example, let's say milk and coffee powder. Okay, Milma and Brew. If milk goes up by 10%, not everybody uses milk to drink coffee. Some people drink tea, some people drink Bonvita, I drink Milo. So let's say half the people drink coffee. So if milk sales goes up by 10%, coffee sales could go up by 5%. That is a positive correlation of 0.5. Negative 0.5, the other way around. If A comes down by 10%, B will go up, move the opposite direction by 5%. Now look at this example that we have just done. Here A and B can be said to have a negative correlation. Look at A, 5, 10, 15, he is going up, whereas B is correspondingly coming down. When A has 5%, B has 18%, highest. When A is at its lowest, B is at its highest. When A is at its highest, B is at its lowest. These two can be said to have a negative. That is what the negative covariance indicates. A negative covariance indicates a negative correlation. How do you measure this correlation? RAB. The correlation between AB is equal to covariance between A and B divided by standard deviation of A into standard deviation of B. Correlation AB equals covariance AB divided by sigma A, sigma B. What is correlation? Correlation is a number between -1 and +1. +1 indicates perfect correlation, positive correlation. Okay, so if one person goes up by 10%, the other person also goes up by 10%. Supporting industries, verticals of the same sector, these have a positive correlation. -1 means rivals. If one guy goes up, the other guy goes down. When Vijay's movie does great, Surya's movie, okay, bad example, but you get the idea. Okay, they are rivals. When one person goes up, the other person goes down. Correlation of 0 means that there is no relationship between the two. One example, let us consider the return of Tata Motors and an 8% FD. Tata Motors and 8% FD. When Tata Motors gave a return of 10%, how much did this fellow give? 8% FD will give 8%. When Tata Motors jumped up to 40, this fellow, he is still at 8%, 8% FD. This guy had a slump, minus 25%. Right now, Tata Motors is struggling, all auto industry is struggling as a whole. So, when Tata Motors went down to minus 25, what happened to 8% FD? He is still giving 8%. Okay. So, now this fellow is not at all influenced by Tata Motors. These two are said to have a 0 correlation. Correlation between these two is 0. Okay. So, correlation basically tells you the relationship between A and B. To find correlation, we need covariance. To find correlation, we need covariance. Okay. So, now we discuss return, we discuss risk, we establish that return is not stable, there could be some deviation. Okay. How do you reduce the risk? You can diversify. Instead of putting all your money into Tata Motors, you can put some money into Tata Motors, some money into 8% FD, some money into Tata Motors, some money into Infosys, something into TCS, something into Reliance. Diversify and that will reduce your risk. When you diversify, tell me, will you choose stocks that have a negative correlation or a positive correlation? Will you choose stocks that have a negative correlation or a positive correlation? See what happens, suppose you diversify into 2 stocks that have a positive correlation. Okay. What is happening over there? When A falls down, B will also fall down, both will collapse and you lose all your money. The entire purpose is defeated. Invest in stocks that have negative correlation. I am very sorry about that. Invest in stocks that have a negative correlation or a low correlation. It will be very interesting note that if you look at our macroeconomic situation, India received a lot of foreign direct, India continues to receive a lot of foreign direct investment. Leaving the government policy aside, one of the reasons why foreigners like to invest in India is that the correlation between Indian economy and the world economy is not negative, but it's very low. Okay, it's a very low positive figure. So, whatever happens, if you have gone through the news, the 2008 financial crisis that happened across the world did not affect India to such a scale. Okay, because Indian economy has a very low correlation with the world economy. Now, that is an incentive for many companies to come and invest in India. So, if they have a head office in US, they will also have a subsidiary in India, so that even if the world economy is in shambles, if America is going down, if China is going down, India is kind of resistant. If India is going down, the rest of the world is not affected by it. The correlation between these two is kind of low. Okay. So, as an investor, it is prudent to keep your correlation the minimum, preferably negative, but negative is quite hard to find in the market, preferably negative, but if it's not negative, a very low positive. Okay. And this juncture, you also note that correlation of -1 and correlation of +1, although we do problems on that, these are kind of theoretical figures. You won't get a correlation of +1 or a -1 in the market. Practically, correlation of -1 and correlation of +1 may not be possible. You won't have a scenario where one company goes up by 10% and the rival company exactly falls down by 10%. Practically, this will not happen. Okay. So, -1 and +1 are theoretical. However, when we go to derivatives chapter, when we are discussing derivatives, this one will become practical. We will discuss at that point. Okay. So, now we are done with correlation and covariance. So, what all formulas have we discussed so far? We started off, quick revision guys, come on, sing with me. We discussed first R, actual return. R equals D1 plus P1 minus P0, the whole divided by P0 into 12 by M plus G. Expected return, X bar is nothing but the average summation of the individual returns divided by number of items, or summation of individual returns into probability. Okay. Standard deviation is equal to square root of summation of x minus x bar the whole squared divided by n or into p. Covariance, please don't make covariance naked, always write as covariance A, B or whatever are the items. If you have two stocks B and D, covariance B, D. Always write what is the covariance about. Covariance AB is equal to summation of x minus x bar into y minus y bar. We have seen an example. I hope you have all written down the example. Into P, summation of x minus x bar into y minus y bar into P, and correlation AB is equal to covariance AB divided by sigma A, sigma B. Okay, this is a summary of what we have done so far. Actual return, what you are actually earning, expected return, based on what you are actually earned for the past 5 years, what do you expect for the next year, standard deviation. You have an expectation, are you sure you will meet that expectation? No, you are expecting 10%, might go up to 15, might come down to 5% is your standard deviation. Covariance and correlation, covariance doesn't have much of meaning of its own, covariance is only a working note to find out correlation. Correlation lower means these two items are not related. Correlation plus 1 means they are related. If A goes up, B also goes up. If A comes down, B also comes down. Correlation negative means if A goes up, B comes down. That is how they play with each other. Okay. So, now we have decided, okay, chalo, let us go and diversify. Now, when we diversify, what happens? When we diversify, when we invest in two or more stocks, we have a portfolio. Portfolio simply means a collection. Portfolio simply means a collection. Two or more stocks you have in your portfolio. You have invested in Reliance and Reliance Industries and Infosys. So, those two stocks combine to form your portfolio. When you have invested in a portfolio, what happens to the return and risk? Okay. So, now we have a portfolio. Imagine your portfolio, you have 1 lakh rupees, you have rupees lakh. You invested 40,000 of that, which means 0.4 of your total investment is in Infosys, which is giving you a return of 12%, and 60,000 or 0.6 of your total investment, 60% is in Wipro, which is giving you a return of 18%. Okay. So, Infosys is giving you 12%, Wipro is giving you 18%. What is the total return you are earning on 1 lakh? Very simple, you have done weighted average cost of capital in Inter. Out of this 40,000 you are getting 12%. So, on 40,000 you are getting 12%, so that is 4,800, or you can say 4.8. Out of 60,000 you are getting 18%, 0.6 into 18, okay, this is going to take some while, I think it is 10.8%, 10.8%. So, in the total 1 lakh, you are getting 15.6%, nothing with the weighted average. So, from this we can say that the return of portfolio, okay, I will take a fresh page. The return of portfolio RT, return of portfolio, is equal to nothing but weighted average. How do you take weighted average? WARA, weight of A, that is proportion of your investment in A into return of A, plus WBRB plus WCRC, where WA is the proportion of investment in A. Out of the total investment of 1 lakh rupees or whatever, how much percentage, what proportion have you invested in A? WA equals proportion of investment in A, that is investment in A divided by total investment. Return of portfolio equals WRA plus WBRC plus WCRC plus it goes on WDRD plus it goes on forever. Okay, what have we done? WA, proportion of investment in A into return of A. 0.4 and 12% is 4.8, 0.6 and 18% is 10.8. Return of portfolio is 15.6%. It is nothing but your weighted average that we have discussed earlier. So, return portfolio is done. Next, what is the risk of portfolio? Same example, 0.4, 40% of your investment goes to Infosys, that has a risk of 10%. 60%, 0.6 of your investment goes to Wipro, that has a risk of 20%. So, what is the total risk of your portfolio? 0.4 into 10 is 4, 0.6 into 12 is 0.6 into 20 is 12, total is 16%. Okay, risk of your portfolio 16% is absolutely wrong. This is a wrong answer because of correlation. Understand? Okay, listen carefully, guys. Understand? When you talk about risk, there is an element of correlation. Understand what is happening? A and B, these are the two investments, A and B. A has a risk of 10%. What does the risk of 10% mean? You are expecting a certain return. How much do you expect? From A, which is Infosys, I was expecting 12%. Now, this can go up or come down by 10%. There is a possibility 10% increase or decrease. Similarly, for B, I was having some expectation, I think it was 18 or something, which can go up or come down by 20%. Okay, it's a risk. It can go up or it can come down by 20%. Now, when you put those two together, what happens? 40% of your investment is in A, which has a risk of 10%. Suppose the net impact is a fall of 4%. Now, 60% is in B, risk is 20%, 0.6 into 20, 12. Now, understand, if A and B have a negative correlation, what happens? When A comes down, B will go up. So, the net impact will be 8%, correct or not? There is the impact of correlation. A has a risk of 10%, means it can go up or down by 10%. B has a risk of 20%, means it can go up or down by 20%. Now, when you put those two together, you have to look into the correlation. If they have a negative correlation, these two could cancel each other out and the resulting risk will eventually reduce. Understood? That is the beauty of correlation. So, when you are computing for return, it is just weighted average. For return, it is just weighted average, no drama, chill. But for risk, you have to consider the impact of correlation. You have to consider the impact of correlation. Accordingly, risk of portfolio, standard deviation of portfolio, sigma p is equal to square root of WA, sigma WA we discussed, W is the proportion of investment in A, the whole square, W sigma whole square, plus WB sigma B, the whole square, plus 2 into WA WB sigma A sigma B correlation AB. Might seem a little complicated, but if you remember something from your school, there is nothing but A plus B the whole squared, except this RAB is coming additionally. Okay, A plus B the whole squared is A squared plus B squared plus 2AB into correlation AB. Okay. So once again, count guys, risk of portfolio standard deviation sigma P is equal to square root of WA sigma A whole squared plus WB sigma B whole squared plus 2 WB sigma A sigma B into correlation AB. Now, have you seen this fellow before? Sigma A sigma B into correlation AB? Think we have seen him. What is the formula for correlation? Okay. Correlation equals covariance AB divided by sigma A sigma B. So from here you can say that covariance AB is equal to correlation AB into sigma A sigma B, correct or not? Cross multiplication. Covariance AB is equal to RAB into sigma. I have cross multiplied over here. Okay, I have cross multiplied. Covariance AB equals RAB into sigma A sigma B. That is what we have over here. To WA sigma B, WAWB sigma A sigma B correlation AB. So you can also write risk of portfolio equals, pay attention, focus guys, WA sigma A and the whole squared plus WB sigma B the whole squared plus 2 into WA WB. Now this line will be replaced by covariance AB. Risk of portfolio sigma P equals WA sigma A whole squared plus WB sigma B whole squared plus 2 WA WB covariance of AB. Got it? Brilliant. Now there are 3 issues to be discussed under risk of portfolio. 1. What happens when RAB is equal to +1 or -1? Issue number 1. Issue number 2. What happens to the risk of portfolio when there are 3 or more stocks? How do you compute? Now, if you have noticed, sigma P equals WA sigma A, WB sigma A. I will consider only 2 stocks. What happens when there are 3 stocks? What happens when there are more than 3 stocks? And issue number 3. How do you ensure sigma P is the least minimum risk portfolio? How do you ensure that risk of portfolio is minimum? Issues number 2 and 3 we will discuss later while we are doing the problems, because I know that you are kind of stressed out with all these formulas bombarding into you. Please bear with me, I will have to discuss a few more formulas and I want to do it in one stretch so that you get that continuity. Okay, you get that continuity. Secondly, when we do the problems, it creates a better learning experience. It creates a difficult learning experience. Mind you, the first chapter guys, portfolio, warning, statutory warning, you might find it a little difficult because all the formulas are coming to you, they are bombarded in your head, then you are doing all the problems, and when you are doing all the problems you have to recollect, return, risk, covariance, correlation, blah, blah, blah. You get kind of tensed, that kind of freaks you out. It is going to be a difficult experience. The reason I am doing that is, when you are going to exam, you have to recollect the formulas and the concepts from all the chapters from the entire syllabus. Okay, when we go to international finance, you will have to recollect concepts from portfolio, derivatives, equity valuation, CA, inter, all these concepts you will have to recollect. Okay, so for that recollection experience is why I have designed the course structure this way. Please bear with me, a few more formulas we will discuss. It's starting to get really interesting now once we enter into required. Okay, so bear with me guys. These 2 issues we will discuss later. This one I just want to mention it very quickly. Okay, so once again, this should go to your formula page like everything else you have done so far. Okay, risk of portfolio. Once again, recollect the formula. What is the risk of portfolio? Square root of WA sigma A the whole squared plus WB sigma B the whole squared plus 2 into WA WB, sigma A, sigma B, correlation AB. Okay. Now what happens when correlation AB is equal to plus 1? What happens when correlation AB is plus 1? Okay, very simple. Sigma P is equal to square root of WA sigma A the whole squared plus WB sigma B the whole squared plus 2 WA WB sigma A sigma B into 1. So, that is the term itself. Okay. So, now we have gone back to school. Sigma P equals square root of WA sigma A whole squared plus WB sigma B whole squared plus 2 WB sigma A sigma B. This is nothing but A squared plus B squared plus 2AB. We can shrink it. That is equal to square root of WA sigma A plus WB sigma B the whole squared. Square root and square will get cancelled. You get risk of portfolio is equal to WA sigma A plus WB sigma B. Okay. So, this entire big gigantic drama has boiled down to the simple formula. Okay. Risk of portfolio equals WA sigma A plus WB sigma B if correlation is plus 1. If correlation is plus 1, you can use this shortcut. So, somewhere in the question if they have mentioned correlation is plus 1 or if they have mentioned that it is perfectly correlated, correlation becomes plus 1 and you can use this shortcut. Whenever you can use shortcut, please use the shortcut. Okay. Similarly, when correlation is minus 1 क्या होता है? Let's discuss. When correlation is minus 1. Okay, WA sigma A whole squared, WB sigma B whole squared plus 2 WA WB sigma A sigma B into minus 1. So, this entire term becomes minus A squared plus B squared minus 2AB is A minus B the whole squared. Okay, please revise your 6th standard mathematics. A minus B the whole squared, square root and square gets cancelled, you get sigma P equals WA sigma A minus WB sigma B. Understood? When it is positive, WA sigma A plus WB sigma B. When it is minus 1, it is WA sigma A minus WB sigma B. For no other figure, there is a shortcut. Okay, if correlation is plus 1 or minus 1, you can use one of these shortcuts. For any other figure of correlation, you have to use this entire formula. Clear? Pakka? Got it? Okay. So, that is it with risk of portfolio. Okay. So, now so far what have we discussed? Let us go back to our basics. We discussed actual return, we discussed expected return, we discussed risk, and we discussed how to reduce the risk through diversification. For diversification, we also discussed covariance AB and correlation AB. Okay, and then we decided to create a portfolio, return of a portfolio and risk of a portfolio. Okay. On that note, let us finally come to the reason we are studying this chapter is required return. I have goosebumps, guys. I am really excited. Okay, this is fun. Okay. So, finally, let us discuss required return. If you have been taking lecture notes so far, please put your pens down and pay attention. Okay, I will try to write as much as possible and I will tell you what to write very clearly. Okay, so you have come to the reason we are learning this chapter is to understand what is the concept of required return. Okay, so let us understand required return. Pay very close attention. This is a beautiful concept. This concept is repeatedly tested in the problems of this chapter. If you don't understand this concept, it is difficult to understand the rest of the syllabus. Okay, the reason I have taken portfolio first is so that you understand what is required return. And only if you understand required return will you understand the other concepts of IRR, K, all those other concepts in capital budgeting, mergers and acquisitions, security analysis, equity valuation, all those concepts. If you want to know, you need to understand what is required return. Required return is symbolized by K. Okay, fine. What is required return? You have invested, suppose you have invested in a stock, you have invested in Infosys. You have invested 1 lakh rupees of your hard earned money in Infosys, and now I am asking you, hey Baba, you have invested 1 lakh. Tell me how much do you want? Forget it, forget all that. Okay, you qualified. You qualified, you are going to campus interview, and the interviews ask you, dude, chill interviewer, dude, what is your expected salary? Okay, how much do you want? How much do you want? What kind of package do you want for the company? What will you say? Depending on various factors, you could say somewhere between 50,000 to 1.5 lakh. Okay, depending on if the campus at Metro, if you are a first attempt rank holder, based on all those factors, you are going to quote a figure from 50,000 to 1.5 lakh. Okay, it's quite a range. But tell me, why did you peg your minimum at 50,000? See, you can live very comfortably with 30,000 also. Okay, it's not like 30,000 is unlivable. With 30,000 also, with basic necessities, you can live. Why do you need 50,000? Oh, because you have needs, because you have desires. Okay, then why did you limit it to 1.5 lakh? You could have asked for 15 lakhs. Or you could ask for 1.5 crores. Nobody is like, no, 1.5 crores. No, I don't want it. Chichi. I will only have this much. Okay, if you have 1.4 crore, accordingly you will spend. You will start buying BNBs and bungalows and land, and all those things will happen. Why did you limit your desire to 1.5 lakh? Even when you dream of a BMW and an Audi and this whole array of cars, Benz, BMW, Audi, Lamborghini, all that lined up in your big mansion, still you have limited your requirement to 1.5 lakh. Why is that? Guys, understand the concept of required, the concept of K. It's a very human concept. It's a very human concept. When you invest, when you go for, why did we ask a salary of 1.5 lakh? It is because that is a market rate. Okay, you asked your seniors going to campus, you asked the other companies, checked out the other companies, what kind of offers they have, and according you have a sense, every other company in this campus is generally offering 1.5 lakh, therefore I will also ask for 1.5 lakh. Okay, every other campus in this campus, every other company in this campus is offering 50,000, therefore I will also want to take only 50,000. Okay, that is the psychology of requirement anywhere in the world. Now, in investment also, when you are investing in Infosys, guys, when you are investing in Infosys, what is your required return? You don't have any requirement of your own. You don't have any requirement of your own. What is your requirement? You look around. Hey, TCS, how much are you getting? Wipro, how much you are getting? Everybody is getting 10%. Okay, then I also want 10%. Okay, that is the psychology. So, point number one, first point, understand. You can write down now, KE is equal to return on market. Point number one, the required return is equal to return of market portfolio. What is the market? Market is the average of all the other companies that you have in the Sensex. Okay, market is basically, in the practical terms, it is symbolized by your Sensex or your Nifty. Hopefully, we will have a session on what is Sensex and Nifty somewhere along the line. Okay, I want to try to keep this as much as exam point of view, but at the same time, I also want to convey as much about the market and practical sense as possible. So, let's see. So, market, basically Sensex and Nifty are thermometers that measure the market. Return of Sensex is nothing but return of market. So, Sensex and Nifty basically, not very accurately, but they are intended to represent the entire market, which is every other company in existence in India. Okay. So, what is your required return? Your required return is basically the average return of the market. How much is every other company in the market getting? That much I also want. Point number one. Understood? Point number one. So, you can write down point number one, required return equals return of market fundamentally. Now, I am going to expand upon it. Point number two. So, I just mentioned that required return is return of market. Now, I am going to analyze return of market a little further. Okay, I just found out return of market, RM. Market has an average return of 9%. Let Let us discuss. Sorry. Market has an average return of 9%. Now, out of that 6% is called a risk-free rate of return. This is the return you get if you make a simple FD in the bank. Okay, if you deposit any money for FD in the bank, or if you invest in government bonds or treasury bonds, the return you are going to get is 6% guaranteed return, no risk at all. Understand? No risk at all. If you invest in the market, when you are investing in companies, there is an element of risk. We have discussed before. Okay, but 6% is risk free, which means when you invest in the bank or when you invest in government bonds, you are getting 6% return. Okay, now once again I am asking you, what is your required return? Think a little further. Okay, required return KE is equal to, what is your required return? First of all, risk free return 6% is something everybody is getting. People who are taking no risk at all, they are getting 6%. Okay, I am taking risk. I have invested in Infos, I have invested in a stock. I am taking risk. So is it fair that I get any less than 6%? No. Okay. So in this case, I am not ready to make any compromise. I am not ready to make any compromise. RF I should get guaranteed. No matter what happens, RF I should get plus. Okay. So 6% you should get. So first I said K is equal to RM. Okay. Now I am breaking it down. Out of this 9%, 6% I should get, no compromise in that matter. Remaining 3%. Are you ready to compromise? Yes, I am ready to make some slight adjustments for the remaining 3%. What kind of adjustments? See, the market, okay, the average of all the companies in India have an average risk. Risk of the market is, say, 10%. The stock in which you have invested or the portfolio in which you have invested, a risk of portfolio, you know how to compute risk of portfolio? Risk of the portfolio in which you have invested is 5%. Now understand, RF 6% everybody is getting, okay? Let us not discuss that, we have left that over here. RF 6% everybody is getting. What about the 3%? The market is getting 3% premium because the market has a risk of 10%. Understand? The market is getting additional 3% because the market is suffering a risk of 10%. Are you suffering 10%? No. You are suffering 5%. So do you deserve 3% premium? Market suffering risk of 10%, so he is getting a premium of 3%. You are suffering a risk of 5%. How much do you deserve? You deserve 3%. You deserve only 1.5%. Correct? Okay. Now, what if you had a risk of 20%? You are at risk of 20%. Market has 10% risk and he is getting 3% return. You have 20% risk. Don't you deserve a premium of 6%? Okay, so market is happy with 6 plus 3. You need 6 plus 6. You need 12%. Okay, so now that brings us to a required return equals RF 6%. I will take it as it is plus the additional 3%. RM minus RF, I will take it in the proportion of my risk to the market's risk. What is this proportion? I am suffering double the risk of market, means I need double the premium of market. I am suffering half the risk of market, means I need only half the risk of market. So your required in RF equals RF plus sigma P by sigma M into RM minus RF. Okay, this equation is called capital market line, CML. It's called CML. Okay. Now, just an exam note, CA final students, this formula is never used for the exam, but CMA final students, this formula is used in some of the questions. Okay, so please refer your modules. Some questions use CML. CA final students, CML is not there. None of the questions are solved using CML. Okay, CML is wrong according to you. CML is only taught as a working note for the third step, step 3. Okay, So let us move on to step 3. Step 2, Ke equals Rf plus sigma P by sigma m into Rm minus Rf is almost correct, not fully correct, almost correct. Based on that, I am going to formula number 3. This is called capital asset pricing model. I am too lazy to write the whole thing, so please note down capital asset pricing model, CAPM. What the CAPM says, the CAPM says, okay, CML, KE equals RF plus sigma P by sigma M into RM minus RF. This formula is almost correct, not fully correct. Why? Because over here you have used sigma P. Sigma P is 20%. The risk of your investment, you have invested in Infosys has a risk of 20% and you have taken the entire 20% over here. There is a slight issue over there. Okay, let us see what CAPM has to say about it. CAPM says, okay, see, you are saying risk is 20%. You are saying risk is 20%. You have taken the entire 20%. There is a small issue over there. I object, Your Honor. What is the issue? See, friends, risk consists of two parts. There is systematic risk and there is unsystematic risk. There is systematic risk and there is unsystematic risk. What is systematic risk? Systematic risk, basically it arises from the market. It arises from the market. It is predictable and it cannot be reduced by hedging. Okay. Unsystematic risk arises due to internal reasons. It is completely unpredictable and it can be reduced by hedging. For example, let's consider my coaching center, Swasthik Academy. I am asking you, dear friend, please invest 1 crore rupees with Swasthik Academy so that we can open new centers in Chennai, Bangalore and Hyderabad. Here, that's our plan. Okay, so if you have money, please, if you have money to spare, please invest 1 crore rupees. When you invest, you have considered a return. We have given progressive great returns over the past few years and now you are concerned about a risk. Okay, so we have some risk. Assume we have risk of 20%. Okay, what is the risk of Swasthik Academy? What is the risk that Swasthik Academy is suffering? Swasthik Academy has some risk due to internal factors. What are the internal factors? The faculty is not good, the faculty is not delivering. Internal reason. The management committed fraud. Internal reason. Okay, there is some dispute amongst the faculties or dispute between the faculties and the management or some fraud happens or something of the sort. It arises due to internal reason and it is completely unpredictable. You don't imagine, you don't expect Ramalinga Raju or Satyam to commit a fraud. You don't expect Punjab National Bank such a fraud to break out. You don't expect Kingfisher to all these things happen. These are internal and these are unpredictable. And you can avoid. How do you avoid it? You can hedge. Okay, don't put all your money in Swasthik Academy. Invest in couple of other securities. Invest in 2-3 other coaching centers. Invest in some other business. Okay, so thereby the risk that arises due to some fraud committed in Swasthik Academy will be reduced, will be diluted. That is one risk, that is called the unsystematic risk. It comes due to internal reasons. Second, we have systematic risk. So systematic risk affects the market as a whole. The pandemic has affected the market as a whole. Imagine if ICAI comes up with a different regulation, some new change in syllabus, some new change in exam pattern or some new conditions, restrictions for private coaching centers, that will affect the market as a whole. Okay, so you can say systematic risk, more than the word predictable, it is linked to the market. Okay, now we have discussed in the previous both formulas, we are pegging our required return to the return of market. Okay, and that is exactly what systematic. Systematic risk is that portion of risk which is correlated with the market. It is coming from the market, it is linked to the market, it is correlated with the market. Okay, so what is systematic risk? It affects the market as a whole. Every company is affected by it in some way or the other. Different companies, different industries in different ways. Now what CAPM says is, in this formula, you have taken total risk, which is wrong, because you are pegging, you are comparing required return to market return. Okay. So, when return is compared to the market return, the risk should also be only that portion of risk which is correlated with the market. Think of it this way, you are investing in Swasthik Academy. Okay, what is the return that you require? Look at the industry in which you are working. Look at the industry in which we are looking. Look at our business conditions, and based on that you can decide the required return. It is unfair to say, hey, I think you are going to commit a fraud, so I need a 10% premium. That is unfair and that is unreasonable. Okay, I think you might commit a fraud. Okay, so give me 10% extra. That is unreasonable. You are in this sector, coaching center, which is susceptible to this pandemic risk. So let's have some more return. You are in finance, which is susceptible to financial risk. You are in real estate, which is susceptible to so much risk. So according to that systematic risk, you can demand a certain return. You cannot demand return for unsystematic risk. So CAPM slightly modifies the formula. He says or she says K is equal to RF plus sigma P into RPM, that portion of risk which is correlated with the market. Risk of portfolio into correlation between your portfolio and the market, divided by sigma M into RM minus RF. Okay, this formula is called securities market line, and this is the true formula for, or this is the most appropriate formula for KE. This is the default formula in any question. CA final students, in any question you are required to find KE. KE equals RF plus sigma P by sigma M into RPM into RM minus RF, where RF is the risk free rate of return. You need that return no matter what. You need that return no matter what. The risk premium RM minus RF, this 3% that we discussed earlier, this 3%, you need it in the proportion of, what? You need it in the proportion of systematic risk to the risk of market. Not sigma P by sigma M, sigma P into RPM by sigma M, where RPM is the correlation between your portfolio and the market as a whole. How much are you susceptible, or how much are you influenced by the market as a whole? That is RPM, correlation. Correlation we discussed earlier. RPM is correlation between your investment and the market as a whole. So K equals RF plus sigma P by sigma M into RPM into RM minus RF. This can also be written in short as K equals RF plus beta into RM minus RF, where beta is called the sensitivity, beta is equal to, that's a very poorly written beta, I will write a little neatly. Beta equals sigma P by sigma M into RPM. Okay. Now I think we know what is the formula for RPM. What is RPM? RPM is equal to covariance PM, covariance between portfolio and market, divided by risk of portfolio into risk of market. Substitute that over here, you get beta equals sigma P by sigma M into covariance PM divided by sigma P sigma M. Your sigma P gets cancelled, you get beta is equal to covariance PM divided by sigma M squared. Okay, so you have two formulas for beta. Beta equals sigma P by sigma M into RPM, or beta equals covariance PM by sigma M squared. Okay, and what is beta? Beta is sensitivity. Beta tells you how much your company will be influenced by any impact in the market. If your market falls, crashes or rises by 10%, how much will that affect you? Suppose the beta is 2. So any impact in market, you follow the Sensex. The Sensex crashed by 2%. You see the news, Sensex crashed by 2%, and you have a beta of 2, means your portfolio would have crashed by 4%. That is what beta simply means. Okay. Can beta be negative? In theory it can be, because covariance can be negative. So in theory beta can be negative, but generally beta stays positive, because the rule is when the entire market is going down, every company is going down. Okay, it can never happen that the entire market is crashing but this company alone is rising. Okay, except in extraordinary situation like when there is a war, the entire market will crash, but some industries like weapons manufacturing, these industries could rise up. Okay, so in very exceptional situations you have a negative beta. Beta is generally between 0 to 2.5 or 3, depends on the market. Okay, you don't have a strict rule, but exam generally if you see a beta of beyond 3, just recheck your answer. You could have gone wrong somewhere, not necessarily you could have gone wrong. Okay, so that is it for today, guys. Hope you enjoyed. So these are all the basic formulas that we need in portfolio management. Okay, now in the next session we will start off with the problems, and that will give you some more clarity on what is happening. Okay, so how to approach the problems, what are we doing in the problems, we will discuss in the next video. Thank you so much. Bye.